really a devastating bear market going on. A lot of stocks are down 40, 50%. Meta, right? Facebook, as an example, one of the big major social media companies and one of the major parts of the S&P 500 is down almost 50%. So, there's been a lot of devastation below the surface, but if you take a look at the market itself, it's down 5-6% for the year. So really kind of no big deal. Again, that's if you look at the surface. If you happen to own shares of companies, particularly in the small cap index, mid cap index, that story is markedly different. And again, it always comes down to where you're investing and how you're investing. But the Fed is again, they're trapped in this point about needing to hike interest rates to combat inflation. Inflation, of course, running very strongly here. Fed Mary Daly out this morning talking about needing to hike by 50 basis points. And the question really becomes, at what point does the Fed run too far, right? And this has always been the case. The Fed hikes rates historically to slow inflation by increasing borrowing costs, increasing transaction costs within the economy. That slows down consumption. But at the same time that the Fed is now hiking rates, you've got interest rates on the 10-year Treasury has moved up sharply. That's creating monetary drag in the economy. You've got higher prices, which are impacting consumers, that inflationary cost. That's creating monetary drag in the economy. So you have a lot of policy tightening or monetary tightening within the economy even before the Fed starts hiking interest rates. So the question is always the case is how far can the Fed hike rates before they break something? Mike, welcome to the show this morning.
Yeah, thank you for having me.
Sure.
And before we answer that question, you brought up something a little bit earlier that I'd like to actually go back on. You said that the government, and I know the state of California is doing this too, is thinking about writing checks to people to help with the higher price of gas and inflation in the case of California. And Canada is proposing, I'm not sure if they've done it, but they're proposing the same thing as well. What this clearly shows is that A, they don't care about inflation, or B, they don't understand inflation. So when the Fed does QE, they're not really printing money. I know we like to call it printing money. Other people call it printing money. They're not really printing money. They're simply putting reserves into the system. With reserves, the banks can lend money when all money is lent into existence.
Right. So real quick, let me stop you there because this is an important point because I get a lot of emails and a lot of comments from people and they all point to the Fed and they say, well, the Fed is going to keep printing money and that's going to keep causing inflation. But this is a really important point that we can't gloss over because what the Fed does is an asset swap. They don't print money. They simply swap, as you pointed out, right? They are a bank has a $1 billion worth of U.S. Treasuries on their books. Well, actually, let me back this up one more. Let's start at the beginning of how the cycle actually works. And I think this will help people understand more about how QE functions versus what we're going to talk about in a second, which is the government actually printing money. So when the Treasury or when the government wants to spend money they don't have, they need to issue bonds. And in order to issue the bonds, the Treasury Department has to issue those bonds. Well, in order to get cash from the bond issuance, they have to sell those bonds to someone. They don't sell those bonds to just anybody, right? There is a group of 20 what we call primary dealers. These are your major banks. This is J.P. Morgan, Goldman Sachs, Bank of America, all those guys. There's some foreign banks in there as well. So they all show up to what we call an auction. And every month we have these bond auctions. And this is where the Treasury Department goes to market and says, okay, I need to raise $1 billion worth of capital to pay for spending that the government doesn't have revenue for. This is called the deficit. And so we're going to sell these bonds. And so these 20 primary dealers, they all stand up in a room, and not technically, it's all electronic now, but theoretically they all stand up in a room, and there's a shot caller at the top, and he says, okay, he's going to give me 100 cents on the dollar, 101 cents on the dollar, whatever it is, and that is how the yield on these are ultimately set, and this is where we know kind of what, and we look at the market and say the yield on, the treasury today is 2.3% or whatever it is. And that's just the price versus the issuance. So now the banks have all these bonds. So now the banks have bought the bonds from the government. So now the government has the $1 billion and the banks have the bonds. Now, used to be back in the day, these new issues would have to sit on the books for a couple of weeks, and they would call aging the bonds, right? And then they would ultimately get sold off to Mike, right? Mike has a brokerage account at Merrill Lynch. He wants to buy a treasury for his account, and he would talk to his brokerage firm, and the brokerage firm would say, yeah, I'll get you that bond. And they would buy the bond from JP Morgan, and they would put it to your account. The treasury would then make interest payments to Michael Lebowitz. So Michael Lebowitz would get an interest payment from the treasury every quarter for his treasury bond. Worked fine and dandy. Then the Fed came up with this great idea in 2008, and they said, we're going to do quantitative easing. Now, how does this work? The difference is that now the Fed is the customer of the banks. So now this is to Mike's point, right? This is where we get into the asset swap, and this is why this is important, that this does not create inflation. Instead of Michael Lebowitz buying the bonds from JP Morgan, the Fed has these open market purchases, and they go to JP Morgan and say, that $1 billion in treasuries you just bought from the Treasury Department, I'm going to buy that from you. And they credit the bank's reserve account, which, as Mike stated a second ago, the bank then lends that money out, supposedly lends that money out. We'll talk about how that doesn't happen either. We'll get there, Mike. But the Fed now buys the bond from JP Morgan. So they've now got the bond. They credit JP Morgan's reserve account with cash. That's the asset swap. There's no money printed. They just digitally credit JP Morgan's reserve account with the Fed with $1 billion. Fed has the bond. JP Morgan has the credit. Now, here's the really interesting part of all this. The interest payment from the Treasury Department gets paid to the Fed. That is now revenue to the Fed and expense to the government. At the end of the year, the Fed then remits those interest payments back to the Treasury, which is now income or revenue for the Treasury on the same dollars that the Treasury paid out. So it's nice accounting magic if you can get it done. So Mike, having explained this, now back to you and to your point, this is the important thing. We are just swapping assets. We're not actually printing money. And that's why we haven't had inflation from QE over the last 12 years.
Correct. And money printing doesn't really occur until someone borrows money. And in this case, what we're talking about is the government borrowing money. Issuing debt is borrowing money. Mm-hmm. So they're completing the cycle. The Fed is setting the table for people to borrow. They're making it much easier for banks to lend money, but unless people want to borrow, you're not going to get more money, right. Hence more inflation. So you now have the government that needs to borrow so they can send everyone a check. Those people will spend the money. That is new money, fresh money. That is why we have inflation currently. That's one of the reasons we have inflation currently, because we were writing checks to people in 20 and 21 that was being spent. That was literally money coming off a printing press in this indirect printing press.
Right.
We got inflation. There are supply line problems too. It's a multitude of problems.
Well, it's supply demand imbalance, right? I mean, the reason you have inflation is that you gave people money that they didn't have before, and you shut down the economy, so we didn't have supply that we did have before. So you now have a surge in demand. Everybody's running out to Home Depot to buy new lawnmowers to mow their yard because they're stuck at home, and there's nobody to produce the lawnmowers. So all of a sudden, supply is a lot less than demand. So the guy supplying the lawnmower says, guess what? You're going to pay more for it. And you have inflation. And that's going to occur every time that we do this.
Correct. And even if there were zero supply problems, there was no pandemic, and they just wrote the checks, there would be some inflation. It wouldn't be like what we're seeing today, but there would be some inflation because they are increasing the money supply. They are increasing, in theory, the velocity of money to some degree, and they would have created inflation. Yep.
All right, quick break. We'll come back. We'll talk about the misguided approach, of course, to combating inflation by, well, printing more money. We'll talk about that when we come back from the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
There's a war being waged on your retirement dollar, and unless you act now, you'll lose the battle with inflation, higher taxes, and a lower standard of living. You can blunt the effects of rising prices with our next workshop on combating inflation in retirement. April 2nd at the Embassy Suites, Houston. Richard Rosso and Danny Ratliff will help you fortify your life savings, make the most of Social Security, and lower your taxes. Register now for this free workshop at realinvestmentadvice.com. Combating inflation in retirement with Ratliff and Rosso. Realinvestmentadvice.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. Realinvestmentadvice.com. Click on the insurance tab.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Talked about how we grew up, right? You know, we didn't have Google. If you didn't know the answer, you just were stupid. That's what I read growing up, was reading encyclopedias.
The Real Investment Show
This
podcast.
is why I have a masterful collection of useless information. So
Same show, your schedule.
I know all kinds of stuff that has no relevance to anything.
At realinvestmentadvice.com.
You know a little about a lot.
I did.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
You can blunt the effects of rising prices with our next workshop on combating inflation in retirement. April 2nd at the Embassy Suites, Houston. Richard Rosso and Danny Ratliff will help you fortify your life savings, make the most of Social Security, and lower your taxes. Register now for this free workshop at realinvestmentadvice.com. Combating inflation in retirement. Realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. I'm your host, Lance Roberts. I made my wife mad at me last night, by the way.
What did you do now?
Well, you know, she works very hard. She's very successful at what she does. In fact, she's one of the first people in the country to start figuring out how to bunker LNG at major ports.
Yeah.
So she's cutting edge on what she's doing. And anyway, she was home last night and she was complaining a little bit about, how she's treated in the office as kind of just one of the guys, right? And I said, it's all fine and dandy, right? Back in the day when we lived in caves, it was like, look, y'all go out and risk your lives to go bring home some meat. Go kill a dinosaur, right? Life and limb under threat. We'll stay over here and just pick some berries, right? Y'all go hunt the buffalo. Bring home the meat, right?
Yeah.
As soon as they get air conditioning in office buildings, we want equal rights. Time that perfectly. Yeah, she didn't like that comment, by the way.
How was the couch last night?
Yeah, it wasn't good. It wasn't good. But, anyway, back to work. It's always something in my household, right? I got two. I'm outnumbered 3-1.
We should start a new channel called Life with the Roberts.
Yeah, no doubt. Kardashians ain't got nothing on my family. Trust me. Well, actually, they do. They have.
Yeah,
that
there's
guy.
That.
Yeah. Yeah.
They got a lot on you, Lance.
Yeah, probably true. Anyway, so just for the break, we're talking a little bit about the Fed here, and the Fed is in kind of a tough spot. They need to hike interest rates to combat inflation, but at the same time, we kind of have the idiocy parade coming out of government, and this is one of the big problems that occurred in 2020, and really this has started back in 2009 as well. Instead of allowing recessions to happen, which are necessary, recessions are not a bad thing. We've created them to be these monsters under the bed that we don't want to have happen, and we want to try to avoid a recession at all costs because it's terrible, right? Recessions put people out of work. They put stresses on family. Recessions are bad, but they're not, right? They're really not bad. There was a study about California wildfires. And one of the reasons that California wildfires continue to get worse and worse and worse is because they're not doing the proper maintenance of the forest, cleaning out the dead brush, maintaining the forest, creating controlled fires to reduce the underlying risk. And because of that lack of maintenance and that lack of care, you continue to have worse and worse wildfires when they occur. And it's the same thing with what a recession does. A recession is a bad thing. A wildfire is a bad thing, right? Destroys a lot of stuff. But it's actually healthy for the forest once these occur, right? It allows for new growth, etc. Same thing for a recession. A recession's a horrible thing when it occurs, but it creates better growth. It reduces excess debt. It reduces excess valuations. It reduces excess in the economy, period, which then allows for a healthier growth cycle to occur. But beginning in 2009, the Federal Reserve decided, hey, we don't want to have recessions anymore. So we're going to start doing all these monetary interventions. And ever since then, we keep running up more and more debt. We've gone from $9 trillion in debt to $30 trillion in debt in just the last decade. And now every time that there's a problem, the Fed immediately comes in to try to start bailing out the markets, and we just create these bigger and bigger deviations in valuations and keep destroying free market capitalism the way it's supposed to work. And then in March of 2020, we endeavored into what's called modern monetary theory, which is starting to send checks directly to households. And this got Congress a lot of kudos, right? It's like, hey, you sent me free money. I love you guys. I'll vote for you every time if you keep sending me more money. And we endeavored into this. Now it's created inflation, but our lovely politicians, they don't understand that it was the sending of money to households that created excess demand for current supply in markets that lifted prices, that creates inflation. As Milton Friedman once says, the only person or the only entity that can create inflation is government. They're the only ones with a printing press. Inflation is always and everywhere a monetary phenomenon. Pensions don't create it. Employees don't create it. Corporations don't create inflation. Me and you don't create inflation. Only the government can create inflation by sending us more money. And now, because we have inflation, what does the government want to do? And this is in an article I can't make this stuff up.
You really can't make this
Yeah.
up, Lance.
Representatives Mike Thompson of California, John Lawson of Connecticut, and Lauren Underwood of Illinois are proposing the idea of an energy rebate equating to $100 a month for individuals or $200 for couples with an additional $100 per dependent. Now, my daughter would love this, right? She was just complaining about filling up her car. But if
was she complaining about that while she's standing in line waiting on a $6 cup of coffee?
No, she complains about that, and we had the gym that she goes to is literally, ladies and gentlemen, walk out my front door, go to the front gate, take a right. It's 300 yards down the street to the gym. She drives. Drives to the gym. So I'm letting her learn her lesson about being frugal. Learn to use your feet, Flintstone. Anyway, like the economics, but here's the point, right? So because sending money to people was so favorable back in 2020, now the government is addicted to doing this. So now every time in the future when we have an economic downturn, expect a check. Right? This is going to be the new policy for bailouts. It'll be cut rates to zero, do QE, send checks to households. These were payments that, and they want these payments to stay in place. For each month, the national gas price exceeds $4 a gallon through 2022. So again, if I'm going to send you money, what do you think retail suppliers of gasoline are going to do? Brent and Mike have more money. I'm going to raise the price of gasoline. Inflation. That's how it occurs. Mike, go ahead.
Yeah, you really can't make this up, Lance. They want to write checks to get votes. In the process, will create inflation. But there's another aspect to this. In theory, we're trying to get off carbon energy. We're trying to become more green to save the environment.
Right.
Well, how do you do that? You let the price of gasoline rise and rise, so you incentivize other sources of energy. Well, now what they're saying is, well, here's more money. Go spend more money on gas. Let's allow the price to rise. There's only two ways the price of gas is going to fall. Supply will increase or demand will decrease. And what they're saying is, well, we're just going to keep boosting demand for gasoline.
Right.
We're going to subsidize everyone to pay high prices for gasoline. And in the quest for votes, they don't even understand that they are creating inflation, and inflation is what's killing their voters. It's really bizarro world.
Right. But again, it's this is the problem with the people that we elect into Washington. We don't elect people that understand economics. We don't elect people that understand financial markets. We put people in charge of financial markets that have no idea about what financial markets are and how they function. Right?
Well, and the scary part is the people that do understand economics, the economic advisors, the Federal Reserve, they cheer them on. They're supporting them. Mm-hmm. The Fed has been abetting Treasury issuance since the financial crisis.
Right.
The Fed was abetting checks. The Fed will still do it. Now they have an inflation problem, so the Fed's got a little bit of a problem. They can't support them as they can't have three cars waiting outside the bank after they rob it. Now they can only have one car. But make no mistake, the Fed will do what they can to support this. And just because the Fed is not doing QE doesn't mean that the money that the QE they did from 6 months ago can't still create money via loans.
Right.
So there's a lot of, just like your forest fires, there's a lot of tinder on the ground for a lot more inflation if the U.S. Treasury, the government, decides to spark it.
Yeah, and again, we kind of keep going back to the same problem now, and the other side of this is that, individuals are already facing a problem of having a cash shortfall. All the money that they did get from the government, they've now spent. Inflation has gone up, which is now a tax on the wages that they're earning. And in fact, wages aren't keeping up with the rate of inflation. And now the Fed wants to make things more expensive by hiking interest rates. And the reason they hike interest rates is to stop people from spending money. And again, kind of to your idea of bizarro world is like, we want to help people. Let's give people more money, but then let's also make everything more expensive, even in the cost of borrowing. I was talking about yesterday, I got a notice from my credit card company. it doesn't affect me that they're raising my interest rate on my credit card from 16.5 or whatever percent. I don't even know what it is, but 16.25, 16.5. I never pay it because I pay the credit card off every month. But they're raising my interest rates. Well, for people that depend on credit cards to shore up the slack in their household spending, that cost is going up every month now too.
The people they want to write the checks to are the people that are going to get hurt the most.
Right. Well, they're the ones, if you take a look at, who spends the majority of their money on just living needs, right? That's the bottom 50% of the economy. So any increase in inflation is a major tax on that level of the economy, really. And that number really runs up to the bottom 80% of the economy, as most people don't have any savings anyway. So, inflation is a big driver, and it's going to be interesting to see. And we'll come back from the break. As I said earlier, Fed Mary Daly wants to hike rates by 50 basis points coming up to the May meeting. And again, the question now becomes, how far can they hike rates before they cause a problem in the economy? Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
There's a war being waged on your retirement dollar, and unless you act now, you'll lose the battle with inflation, higher taxes, and a lower standard of living. You can blunt the effects of rising prices with our next workshop on combating inflation in retirement, April 2nd at the Embassy Suites, Houston. Richard Rosso and Danny Ratliff will help you fortify your life savings, make the most of Social Security, and lower your taxes. Register now for this free workshop at realinvestmentadvice.com. Combating inflation in retirement with Ratliff and Rosso. Realinvestmentadvice.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. Realinvestmentadvice.com. Click on the insurance tab.
Do you know what you don't know when hiring and retaining quality employees? Compensation is more than just wages. It's personal time off, the vacation days, healthcare benefits, a 401k. Do you know what's important to them? Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Let us show you how to make the most of an affordable, effective package that will deliver true value for your business and your employees. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. Michael Lebowitz joining me as well. Talking a little bit now about the Federal Reserve. Again, the big issue, the big conversation here, of course, is inflation. We have inflation. It is a function of monetary policy, and yet we continue to kind of make the same mistakes over and over again in terms of government policy and the creation of inflation. And the Fed is now kind of in this box of needing to hike rates, and they want to start hiking rates more aggressively. In fact, they're going to have to hike rates at least 50 basis points at 2 meetings this year if they're going to make 8 rate hikes by the end of this year, which is kind of what the expectation is. Now, 8 rate hikes would take the Fed funds rate to 2%. The question, and Deutsche Bank recently has a statement out saying that they think the Fed's going to go to 3% on hiking rates. Now, The problem with 3% is that is a rate higher than the 2018 peak in interest rates before we caused a problem in the markets and the economy. And every peak prior has been at a higher level than the previous peak. So in other words, every time the Fed hikes rates, it's always lower than the previous peak that we had going back to 1980. So the question really becomes is how far can the Fed hike rates before they cause an issue either economically in terms of recession, or they create financial instability through a credit-related event. Mike, your thoughts?
This is the age-old problem, and it's becoming increasingly a bigger problem. The Fed raises rates, interest rates. Fed raising rates is not really affecting the economy much. It's the bond market's reaction to those rate raises, right? So it's how do mortgages rise, car loans, corporate loans, all the loans that really drive economic activity. And what we're seeing now, mortgage rates are up to 4.5. People were refinancing or buying new houses with 2 handles, 2 3/4, 2.5, even a few of them got 2 7/8. Now they're 4.5. And the affordability, you can afford a lot less house at 4.5% versus 3% or 2.5%. Corporations have to spend more money on interest expense. Most corporations don't pay down debt. They just roll debt. The U.S. Treasury just rolls debt. And this is an important fact. So they borrow money for 5 years. It's maturity. They owe $1 million. That $1 million then they borrow new money to pay off the old money.
Right.
So they are now having to deal with borrowing money at, whatever the rate may be. If it's a corporation, anywhere from 2 to 5, 6 more if you're, deeply junk, versus what could have been about 2% less not that long ago. So it's hitting corporations' bottom lines. At the same time, wages are going up, their input costs are going up. So what are they going to do? They're going to try to push it through too. So in a way, it creates some inflation. It's hurting individuals. Like you, Lance, you just talked about your credit card.
Right.
Auto loans will go up a little. There's a lot of subsidies in auto loans, but auto loans will go up a little. Mortgages, student loans, you name it. It's really a poor situation for the consumer. So what does it do? It basically creates economic slowdown. And with economic slowdown, you actually bring down the rate of inflation. I know right now at 8%, it seems like it's going to keep going up forever. But the demand will slow down. Even if we do get government checks, it will slow down because the consumer is getting squeezed out of the economy so many different ways.
Yeah, it's called demand. The technical term for that is called demand destruction, right? We're destroying demand through higher rates.
So what happens is as the Fed raises rates, the bond market reacts and rates go up, and it squeezes the economy to the point where the economy stops growing, goes into a recession, and rates come right back down. Mm-hmm. Now, the thing is, we have more and more debt versus income. That's true at a national level, a corporate level, and to a lesser degree at a household level. So as you go through each event, 2008, 2000, back in time, 2015 even, you have higher ratios of debt to GDP, debt to income. So your threshold for higher rates, you're paying with higher rates, you can't afford the higher rates as much. Right. I mean, just think about it. My parents took out their first mortgage. It was like 15 or 18%. Mm-hmm. They didn't have debt on their books. Right. They could do it. They were also getting, my father was getting wage and, his wages were going up by a similar amount. They were, it wasn't fun, I'm sure, paying an 18% mortgage. But
it was normal. We didn't really know different back then. That was just kind of, but you're right. My dad didn't have any credit card debt. They paid for everything in cash. And so the mortgage debt, the mortgage and an auto loan, that was about all the debt the household had. But again, but also people lived a lot more reasonably back then as well. Right. My parents had an 1,100 square foot house. Today, the median household, house is, $275,000 is 3 bedrooms with a pool in the backyard, right? I mean, the lifestyle that we choose to lead today is above what wages will actually support. And so we do it by subsidizing it through debt.
Right. Debt makes it all possible. Mm-hmm. It allows us to live to the excesses. It's what is making a lot of asset valuations, not just houses, stocks, bonds. I mean, you can go right down the list at these excessive values. It's because debt is new money. It's extra money. So when you throw that extra demand into whatever market is you want to talk about, whether it's gasoline, whether it's stocks, whether it's houses, that's the effect. And that's, it's not just inflation at the supermarket for bread or eggs or gasoline. It's inflation everywhere. Now, the difference is in 2008, the government wasn't writing checks. So the inflation showed up predominantly in the asset markets. Now you're having inflation everywhere, not just the asset markets, but in the market, I said, bread, milk. You go out to lunch and it's crazy what it costs now. You go shopping. My wife will send me to go pick up a few things. I'm like, what did I just buy?
Well, this is it. And you're right. Back in 2008, the inflation was in the housing market. And that was driven a lot by subprime mortgages and no money down mortgages, et cetera. It was free money in a different form, right? I didn't have to come out of pocket to buy a house, so I could buy a house, and it created a massive inflationary push. Now we see the same thing again, but this time a lot of this inflation in housing is being driven by corporations buying up houses to turn them into rental properties. So, but again, now to your point, interest rates are going up. So the refinance market is dead. Nobody's going to refinance a mortgage at a higher rate. And for individuals wanting to buy a house, they're starting to get a price out of the home because they could afford the home at 3%, but at 4%, they can't afford the monthly payment. Same thing for auto loans. Auto prices are going up dramatically, especially on used cars. And now if auto loans go up, they can't afford the payment on these cars. So that's going to impact the car market. So again, to your point, we have inflation now. But as is always the case, the cure for high prices are high prices because they'll eventually create demand destruction, and we'll see that probably sooner rather than later.
And going back full circle, now let's talk about this exactly where you started, Lance. What's the government doing? They are not letting this cycle play out. They are not letting high prices cure high prices. They're showering money on us once again. We're not in a recession.
Right.
We're not. We have the lowest unemployment. You have to go back a long period of time. Where the economy is actually I know it's not the 15-20% it was last year coming out of the pandemic. The economic rate of growth is still at the high end of what was normal pre-pandemic, and we're already being told that they're going to shower more money on us because the price of gasoline is up because of inflation. Well, wages are up too. Maybe not the same amount, but they're up. It's horrendous. This is a vote-getting scheme, just like the prior episodes were. Right. I get the desire to help, but they are creating more inflation. They are going to hurt the poor, the low middle class, a lot more than the upper class in what they're doing. But they shield themselves by saying we're Robin Hood.
Well, but this is to your point the other day that you made in your article. One of the other proposals is again, whenever there's high oil prices, it's never anybody else's fault. It's always the energy company's fault. And so, they want to do a windfall profit tax on, oil producers. And we've been attacking oil producers, and everybody's wondering why won't oil companies go produce more oil? Well, you're constantly attacking them, telling them that you're going to put them out of business or nationalize them because they're polluting the climate. But yet, as soon as energy prices get out of control because of what your actions were, now you want to blame them again for doing exactly what you wanted them to do. So, energy companies are in a no-win situation. And now the government wants to do more damage to them by proposing this windfall profits tax.
They don't understand what they're doing. Yeah. What the sad part is, I think they do understand what they're doing. There's enough economists, there's enough people that do understand that. Me and you, Lance, aren't the only ones. There's a lot of people that understand what's happening, but they all want to be reelected. Mm-hmm. And this is both sides of the aisle. Everyone wants to be reelected. So they will basically pay for votes, and they're going to pay for votes. It's great getting a $500 check. I hope I get one. But the cost of that $500 check is that I'm probably going to be paying $600 more for all the stuff that I buy throughout the year. So in the long run, it'll probably cost me $100. But it is nice having that check in front of me.
Well, we had this conversation the other day. Is that they're proposing more money, and again, when we get to the next recession, they'll do it again. But the very function of inflation is simply the payback of the free money we gave people to begin with. Again, we gave them all free money, and they all assumed, oh, it's free money, I don't ever have to pay this back. Well, yeah, you're paying it back now through inflation. So there's always a payback. There's never a free lunch. And this is the one thing that we have never learned, is that you give something away for free, there is always going to be a penalty and a payback period for that. Mike, thanks for joining the show today. Get by the website, realinvestmentadvice.com. Get registered for our upcoming event, Combating Inflation in Retirement. It's April 2nd. It's a live event. So first one we've done here in a while. I would love to see you there it's at the Embassy Suites right here on I-10 and Kirkwood. So go by the website, realinvestmentadvice.com. Get registered today, as seats are filling up for that. And there is limited seating because it is a live event. So make sure you have your seat. It's on the website now, realinvestmentadvice.com. See you back here tomorrow.